Welcome to 3D's fourth quarter 2018 market commentary and updated market outlook. I'm Benjamin Levine. I'm the Chief Investment Officer here at 3D. Thank you for joining us. First, the conclusions. From a global investor's perspective, the best that can be said about 2018 is that it is finally over, although one is hard-pressed to find an investor looking forward to 2019. Very few risk-based assets performed positively in 2018. Much of this year's poor performance came in the fourth quarter. Whether it was the sharp sell-off in global equities, oil prices plummeting from 75 a barrel down to 45, or investment-grade corporate and high-yield funding costs blowing out, the fourth quarter sell-off in risk-based asset classes was both swift and sudden. The two main catalysts that drove the sell-off are the same two we've been worrying about for the better part of 2 years: an over-aggressive Fed and a slowdown in China, trade dispute with the U.S. notwithstanding. But a bad year does not mean that investors can continue to pretend that asset prices are divorced from reality. Just as market performance throughout 2017 and the beginning of 2018 witnessed animal spirits taking market valuations to unrealistic levels, today's depressed pricing environment has produced more attractive or perhaps more realistic valuations despite daily angst over global trade disputes, Brexit, China's slowdown, Federal Reserve overreach, and a credit market shutdown. Heading into 2019, investors are truly staring into the risk-off abyss, with the abyss staring back at them with more attractive valuations amidst a more sobering macroeconomic and political backdrop. One thing has become clear. There is a disconnect between the angst expressed by the market sell-off versus positive U.S. economic data and the Fed's economic outlook for 2019. And negative market sentiment is spilling over into corporate sentiment, as nearly half of chief financial officers believe a recession will start within a year, and 80% think a recession will hit by the end of 2020, according to a Duke University survey. The strength of emerging market performance relative to developed markets throughout 4Q18 is one positive thing to actually accentuate as we look forward. The fact that emerging markets are recovering some of the ground lost during the first half of the year might indicate that fears of systemic financial meltdowns may be overblown. Lower commodity prices and a Fed pause should prove to be beneficiary tailwinds for emerging markets heading into 2019. Another thing to focus on, another positive aspect to focus on, is credit rating agency forecasts for lower default rates in 2019. A cynic might treat rating agency default forecasts with a grain of salt, given the poor track record of their abilities to forecast credit downturns, well after having been priced into the credit markets. However, rating agency outlooks matter when viewed in the context of dynamic interactions between the rating agencies and corporate borrowers, i.e., the credit analysts may be more flexible with company management in a low default environment. Highly leveraged companies may prioritize the interests of creditors over shareholders now that credit markets are not as receptive as they had been the last couple of years. Another one to focus on is that we may find some form of agreement being reached between the U.S. and China over trade discussions, as well as some resolution over the ongoing Brexit discussions between United Kingdom and continental Europe. Combined with the U.S. economic backdrop benefiting from strong employment and consumption and fiscal tailwinds, such positive news should affirm that the outlook is not as grim as what is being priced into the markets. And then finally, we have a data-driven Federal Reserve. Future Fed communications should acknowledge current market weakness and warning signals generated by the credit markets when setting expectations for future rate hikes and balance sheet changes. The Fed may exercise more patience when setting policy in anticipation of inflationary pressures building up in the economy. So we have market pricing pushing risk premiums into from extreme complacency into fear over the short run. But we at 3D believe current valuations in equities and corporate fixed income reflect a more balanced view of the risk and reward. So the theme for our fourth quarter 2018 market commentary is Vigilante No More. And this is based off a famous quote from former Bill Clinton political advisor James Carville back in the early 1990s, when he was quoted as saying, "I used to think that if there was reincarnation, I'd want to come back as the president or the Pope or as a 400 baseball hitter. But now I would like to come back as the bond market. You can intimidate everybody." Hence this idea of the bond market acting as a vigilante on fiscal and monetary policy was born. Back in September 2018, Barron's up and down Wall Street columnist Randall Forsythe resurrected Carville's famous quote when referring to a Bank of International Settlements report. Forsythe warned readers how credit in the world's bond markets had ballooned to what many observers considered to be dangerous proportions. Rather than playing the 1990s role as vigilante to excess spending and debt issuance, the bond market is playing the role as helpless victim, crying to the U.S. Federal Reserve that the world economy cannot withstand positive real interest rates and a withdrawal of U.S. dollar liquidity resulting from the reversal of quantitative easing. Just as a petulant child tests the resolve of his or her parents determined to wean said child off years of spoiled living, the equity and credit markets are testing the resolve of the Fed to pursue its real neutral rate of interest target, estimated at 1%, assuming 2% core inflation, as well as paring back its balance sheet, which had ballooned to nearly $4.5 trillion from $1 trillion prior to the 2000 financial crisis, which is what we show here in this slide. However, in reference to the BIS report, global financial markets resemble more of an addict than a petulant child. According to Forsythe, non-financial credit increased to 38% of global gross domestic product as of the first quarter of 2018, up from 33% 3 years prior, and that the makeup of global capital shifted to debt securities whose share soared to 57%, up from 48% in the onset of the financial crisis a decade ago. The spectacular growth in non-financial credit has produced a bond market that is addicted to quantitative easing and zero interest rates. U.S. dollar-denominated debt, U.S. corporate issued and foreign borrowings, has exploded. Forsythe concluded his column by warning that instead of being all-powerful, bloated bond markets could be the key source of weakness in the next crisis. From vigilante to addict, the bond market signal to the Fed is to forget about normalization of monetary policy as if the world is still functioning in the post-World War II era of business cycles prior to the 2008 financial crisis. Early in 2018, we wrote that markets were getting ahead of themselves despite strong U.S. earnings growth benefiting from U.S. fiscal tailwinds of lower corporate taxes and regulatory relief. After a strong January run, we expected total returns for 2018 would comprise mostly of earnings cash flow growth rather than further narrowing of risk premiums or rising asset elevations. We correctly anticipated that U.S. market valuations had reached a peak in January, but did not anticipate the magnitude of earnings multiple correction that ensued throughout the rest of the year. Growth momentum stocks, i.e. the FANGs, may continue to enjoy premium valuations in an environment of scarce growth, but overall valuations for equity and fixed income credit risk are more attractive following the steep fourth quarter 2018 sell-off. However, even if headline news at the margin becomes more positive, such as progress on U.S.-China trade discussions, a more dovish Fed, commodity price recovery, we would not necessarily expect valuations to return to their 2018 peak levels. We believe over the long run that earnings growth, or lack of, primarily determines market advances or declines, and that the valuations investors are willing to pay for earnings growth reflect a level of confidence or uncertainty in the factors influencing future earnings growth. The U.S. has been trading at a premium to other regional markets primarily due to U.S. companies generating stronger earnings growth and profitability relative to their cost of capital versus other regions that have suffered from lower growth and lower profitability. However, not even the U.S. is immune from the negative sentiment that is showing up in declining earnings estimates as we head into 2019. Here we display the forecasted earnings trend for the major global market regions, denoted by the white lines, against index prices, denoted by the yellow and green lines. Up until recently, the earnings picture for the U.S., which is the top graph, had been the lone standout among major regions, but this is now changing as the slowdown in earnings growth for the U.S. appears to be following the slowdowns experienced by the rest of the world. According to FactSet Earnings Insights, consensus estimates for the S&P 500 earnings growth in 2019 have dropped, with analysts forecasting only 7.9% growth at the end of the fourth quarter, down from 10% growth expected at the beginning of the quarter. And these estimates may drop further depending on company guidance. The path for U.S. earnings growth looks less certain, and less certainty typically results in higher risk premiums demanded by investors. Hence, we would expect U.S. stocks to track earnings growth, but would not expect a higher valuation paid for that earnings growth. Global financial conditions have tightened. Rising U.S. interest rates and a Federal Reserve intent on reaching the theoretical neutral interest rate estimated by their models of sustainable GDP growth, have helped contribute to tightening conditions overseas. The blue line is denoted by financial conditions in Europe, while the red line is denoted by the ones in Asia ex Japan. And you can see that throughout the year, as the Fed has been raising rates, financial conditions have definitely tightened. They've also tightened in the US. Based on this year's adverse reaction to higher interest rates, we could be seeing an upper bound on high interest rates, which are causing real stress within the financial system. Unless economic growth and inflation show signs of taking off, we may have seen the upper limit on interest rates for the time being. The risk regime that characterized low market volatility and complacency throughout 2017 and early 18 has shifted to one of greater uncertainty and expectations of more turbulence ahead as the market awaits with bated breath as to whether this long extended cycle will fall into recession. Here we show risk factor performance for 2018. There is a sharp contrast in performance between the first 9 months of 2018, with momentum leading all risk factors, versus the last 3 months when minimum volatility outperformed all other factors. 2018 was another tough year for value style of investing. Here we display global oil supply versus demand on a year-over-year basis. At the bottom is the supply-demand differential and the 12-month futures oil strip price. The strip price plummeted from $70 a barrel to $50. Some attribute the sell-off to an overcrowded hedge fund trade, which was long oil and short natural gas, and some attribute it to concerns over North American production flooding the market, leading to excess inventories. Regardless, oil demand continues to grow and should benefit with oil prices near $50 rather than $70, especially for energy importing countries that had reduced their oil consumption in response to high oil prices. The supply-demand picture looks more balanced today, although there is always the risk of more production flooding the market. One can argue that much of the recent downcast in global growth has largely showed up in exports, especially exports into China. Despite concerns that the U.S. is facing a slowdown and possibly a recession, U.S. manufacturing and services sentiment remains at elevated levels. Time will tell whether the economic releases catch up to the slowdown implicitly priced into equity and bond market pricing. Here we show the 10-year Treasury yield, the 5-year forward break-even spread between tips and nominal treasuries, and the term structure spread, or the difference between long and short-term rates. All three are indicating a slowdown characterized by low growth and low inflation. The Fed has only recently acknowledged the role market signals can play into setting monetary policy. Along with widening credit spreads, the bond market is signaling to the Fed the end of the rate hike cycle unless economic conditions turn meaningfully upward. So what are the key short-term risks as we head into 2019? We end 2018 and enter 2019 with a standoff between a quantitative easing, zero interest rate addicted market and the Federal Reserve over the near-term direction of monetary policy that will have implications for the pricing of risky financial assets. A more cynical take would picture the standoff more as a struggle between the addict and the rehab clinic trying to administer methadone. An even more cynical take would be to affirm that the new normal secular disinflationary conditions of global excess debt levels, aging demographics, and excess manufacturing capacity have once again prevailed over cyclical reflation, and that the best investors can hope for is global economy characterized by low nominal growth without tipping over into recession. Looking back at our 2017 year-end market commentary, we identified the Federal Reserve and China as posing the two largest risk factors to global market performance. Admittedly, these weren't exactly sticking your neck out calls, although we didn't include the Trump administration as another risk factor. But we also acknowledged the prevailing overhang of new normal secular disinflationary risks despite a rosy cyclical outlook. So the risks that we presented in 2019 are, first, geopolitical tensions. The failure of status quo trading relationships, such as with US and China or over Brexit, the clash of regional security interests, such as the increased tension in the South China Seas, as well as in the Middle East and the Ukraine. The other risk is Fed put versus Fed struggle, or how much volatility is the Fed willing to withstand in their pursuit to normalize monetary policy. The fourth quarter probably answered the question that the Fed put is more likely in place as opposed to a strangle, where Fed officials have backtracked from early quarter comments about monetary policy normalization and pursuing that theoretical neutral rate of interest by suggesting that the Fed instead will be patient and will likely withhold further rate increases unless the data warrants it. Another one is an idea that cyclical reflation is giving way to secular disinflation or deflation. China may determine the near course, at least the near-term course, on cyclical growth. Also, will we see earnings growth turn negative in the U.S.? And does an earnings recession portend an economic recession? And finally, will high-profile downgrades by the rating agencies portend a shutdown in corporate lending as lenders shut the door on corporate financing? At the risk of sounding hackneyed, global risk appetite will likely recover when the market stops selling off in the face of bad news and negative headlines. Sellers will have exhausted themselves, and buyers, at least those with fresh powder capital, will find valuations so compelling as to overlook any lingering negative overhangs. This could take the form of the Fed acknowledging the weakness being expressed by market volatility and widening credit spreads, some of which we've seen already, or the market shaking off their current melees and acknowledging the rosy economic outlook built into the Fed's models. But investors' resolve will likely continue to be tested throughout 2019 until they receive more clarity on major market overhangs such as China's economic outlook and how aggressive the Fed will pursue policy normalization. Now on to the fourth quarter review. Emerging markets led world markets for the quarter. You can see that emerging markets were only down 7.5% for the quarter versus down 12.5% for ex-US developed or MSCI EFA and 13.5% for the S&P. Valuations have definitely come down for all three major market regions, especially international markets where they are trading at the lower end of their 10-year range. And the S&P at 14.4 times forward earnings is trading just below the median of its 10-year range. U.S. fixed income was a beneficiary of risk off. You can see that the Barclays U.S. Aggregate Bond Index, 50% of which is U.S. Treasuries, had a nice return of 1.6%. A lot of that driven by the drop in 10-year yields that we saw in December. You can see the 1.8% in December really propelled that quarterly return. High yield struggled as credit spreads widened, down 4.5%. REITs performed relatively well versus the broader U.S. market, only down 6%, somewhat of a beneficiary of lower interest rates. Commodities were hammered. They were down almost 23%. A large part of that was driven by the plummet in oil prices. And precious metals, another risk-off beneficiary, was up 7.1%. Large caps outperformed small caps, as one would expect during a general risk-off type of regime. S&P was down 13.5% for the quarter, but the S&P 600 or S&P small caps was down just over 20%. Value and growth pretty much performed in line with each other. There was definitely a rotation in defensive sectors. Utilities, again, the most interest rate sensitive among the sectors within the S&P, actually posted a slight positive return. Other defensive sectors like real estate, consumer staples, and healthcare were beneficiaries. And then a lot of the cyclical sectors such as energy, infotech, industrials, consumer discretionary took the brunt of the sell-off. US and Japan underperformed broader emerging markets in Europe. Japan, I think, is suffering from a couple of things. The one being that just the melees that surrounds that economy, no real end in sight in terms of a major turnaround in the economic growth. And they also have become a huge export partner with China. So China's slowdown does, in a lot of ways, will impact Japan. Precious metals did benefit from the risk off, especially when it looked like the Fed was backing off from their hawkish statements surrounding interest rates and adopting sort of a more patient approach. Real estate was a beneficiary of lower interest rates, and as you can see, commodities were down big. We explained earlier that this was driven by oil prices. Thank you again for listening through our fourth quarter 2018 commentary and year-end commentary. If you have any questions, please feel free to email us or contact us directly. As a reminder, we will post a separate presentation discovering performance attribution of our ETF managed model strategies. If you are a contracted advisor, keep an eye out for a link to the performance attribution webcast. This is Ben Levine, CIO at 3D Asset Management, signing off.